So I said in my introduction that the FRC weren't going to make any changes to FRS 102 apart from in the triennial reviews. But this year, due to the exceptional circumstances that we found ourselves in, the FRC have made an amendment to FRS 102 in respect of rent concessions. So it was initially published as FRED 76 and was brought into an amendment to FRS 102 in October. The amendment applies only to rent concessions given by landlords as a direct consequence of COVID-19, of which I'm sure there are many. Normally, rent concessions, usually rent-free periods at the beginning of a lease, are spread over the life of the lease. So without this amendment, the treatment under FRS 102 would be the same, i.e. to spread the concession over the remaining life of the lease. But this amendment says that you don't do that. These concessions were specifically to help businesses out during the pandemic period, so should be recognised in the P&L in the period that the concession is intended to compensate. So effectively, you recognise the reduction in rent charge as it happens. There are certain conditions required to apply this treatment. The change has to be a reduction in rent. It only applies to payments which were due on or before the 30th of June 2021. And there has to be no other change to the terms of the lease. Otherwise, the rent concessions could be due to those changes rather than just to COVID-19. And you need to disclose the change in lease payments in your accounts. The effective date of this amendment is periods commencing on or after the 1st of January 2020, but early application is permitted. So you could apply to the years ending on or after the 31st of March 2020, as long as those accounts weren't signed off before the amendments were issued. The slide says expected in 2020, that actually happened in October 2020, actually on the 7th of October 2020. So any account signed after the 7th of October can apply the amendment for periods after the 31st of March 2020. The support for businesses from the government has resulted in many companies receiving COVID-specific loans and grants. So we thought it would be useful to look at how FRS 102 applies to those different loans and grants. FRS 102 allows an accounting policy choice for government grants, the accrual model or the performance model. The COVID-19 grants are revenue-based grants, so the accounting treatment is the same, irrespective of the model that you apply. So if we consider some of those grants in turn, for the CJRS or furlough grants, you recognise the grant in the P&L as income. You don't offset it against the wages and salary costs. So you recognise it as other operating income as a separate line on the P&L. And you recognise a debtor for any grants that you have applied for but not yet received. The statutory sick pay rebate is also treated as a government grant. You recognise in the profit and loss account as the income becomes receivable. Again, you don't offset it against the payroll cost, and you recognise a debtor for any rebate receivable but not yet received. The business rates relief isn't actually a grant. It's just recognised as a reduction in the rates charged for the period that you get the relief. And therefore, all you do is you reduce the rates charge in your profit and loss account for the period that you get the relief. The other grants that have been available, such as the Small Business Grant Fund and the Retail, Hospitality and Leisure Grant Fund and the Discretionary Fund and the Cultural Recovery Fund, for example, you recognise those immediately in the P&L as income as they're received or as they become receivable. If we then think about the different loans, first of all, think about the CBILS loans. And if we think about the fees and charges that are applied, the government makes a business interruption payment to the lender covering the first 12 months of interest and charges. As we know, the borrower is still 100% liable for the debt. And because of this, interest should be recognised as a charge in the profit and loss account, even though the borrower isn't paying that interest. So therefore, the business interruption payment should be recognised as income in the profit and loss account and not set off against the interest. One thing to consider here, though, is materiality. If the interest charge isn't material with the low interest rates that we currently have, then I'm not sure actually finding out what that interest is and recognising it separately on the P&L account is necessary. But you do have to consider whether it's material. If we consider bounce back loans, these are loans available to smaller businesses, no fees or charges up front. The loans are up to £50,000. And again, the government guarantees 100% of the loan. Again, the government makes a business interruption payment to the lender covering the first year's interest, and the interest is capped at 2.5% per year. Similarly to the CBILS loans, the interest charge should be recognised in the profit and loss account, and the business interruption payment treated as a government grant recognised in the profit and loss account as income, not set off against the interest. But again, we need to consider materiality and whether that interest is material and whether we need to split it out.